Hey everyone, welcome back. If you're studying for the RIBO Level 1 exam, today we're covering a topic that sounds simple but trips people up because the terms sound similar: the different types of insurers. By the end of this video, you'll be able to tell the difference between a stock insurer, a mutual insurer, a reciprocal exchange, and a reinsurer, and more importantly, you'll understand why these structures exist, not just memorize the names. That, why, is what actually gets tested on the exam. Let's get into it. Let's start with the most common type, the stock insurer. A stock insurer is owned by shareholders. These are investors who've put capital into the company expecting a financial return, just like owning shares in any public company, like a bank or a tech company. Here's the key relationship to understand. When a stock insurer makes a profit, that profit goes to the shareholders as dividends. The policyholders, meaning you, the person who bought a home insurance policy, don't get a cut of that profit. You're a customer. You pay your premium, you get your coverage, and that's the full extent of the relationship. Most of the large, well-known insurance companies in Canada are structured this way. Think of it like buying a coffee from a coffee shop. You get your coffee, the shop's owners get the profit. You don't get a vote on how the shop is run, and you don't get a share of this month's earnings. Now here's where it gets interesting: the mutual insurer. A mutual insurer has no outside shareholders. Instead, it's owned by the policyholders themselves. If you buy a policy from a mutual insurer, you're not just a customer, you're effectively a part owner. This changes where the profit goes. Instead of flowing out to external investors, profits can be returned to policyholders, sometimes as a dividend on their policy, or kept inside the company to build up reserves for future claims. Policyholders in a mutual may also get voting rights on major decisions, similar to how a shareholder votes in a stock company's annual meeting. A good real-world example here. Ontario has a number of farm mutuals, insurers that were historically set up by farming communities to insure each other's property. That's the mutual model in its purest form. A group of people pooling risk together for their mutual benefit, not for an outside investor's profit. Quick way to remember the difference: in a stock company, you're a customer. In a mutual, you're a member. This next one is less common, and you won't need to know it in deep detail for the Level 1 exam, but you should recognize the term if it shows up. A reciprocal insurance exchange is a structure where a group of subscribers agree to insure each other's risks. Instead of a typical corporate structure, the exchange is run on their behalf by something called an attorney, in fact, essentially a manager who handles the administration. Think of it as a more informal cousin of the mutual model. The core idea is the same, people sharing risk with each other, but the legal structure behind it is different. For exam purposes, just know the term exists and that it involves subscribers insuring each other, managed by an attorney in fact. You won't need to go deeper than that. Now let's talk about reinsurers, because this is a concept that explains something you might not have thought about before. How can an insurance company afford to cover a $2 million home, or pay out claims after a major flood that affects thousands of homes at once? The answer is reinsurance. A reinsurer is a company that insures other insurance companies, not individual policyholders like you or me. When an insurer takes on a very large or very risky policy, it can transfer part of that risk to a reinsurer, in exchange for part of the premium. This matters because it protects the original insurer from catastrophic losses. Picture a hurricane that destroys 5,000 homes in one region, all insured by the same company. Without reinsurance, that company could be financially wiped out overnight. With reinsurance, that risk has been spread out, so the impact is absorbed across multiple companies instead of just one. Here's an important point for the exam. As a broker or as a client, you never interact directly with a reinsurer. It's a business-to-business relationship that happens entirely behind the scenes. You won't sell a reinsurance policy to a homeowner, ever. One more category worth knowing, mostly so you can recognize the contrast if a question brings it up: government-run, or crown, insurers. In some Canadian provinces, Manitoba, Saskatchewan, and historically British Columbia, auto insurance is run by a government-owned insurer rather than private companies. There's essentially one provider, and it's public. Ontario is different. Auto insurance here is privately underwritten, meaning multiple private insurance companies compete for your business, the same model as home insurance. If you see an exam question contrasting provinces, this is the distinction they're testing. Public, government-run auto insurance in some provinces versus Ontario's private, competitive market. Let's quickly recap what we covered. Stock insurers, owned by shareholders, profit goes to investors. Mutual insurers, owned by policyholders, profit can return to members. Reciprocal exchanges, subscribers insuring each other, run by an attorney in fact. Reinsurers, insurance for insurance companies, protecting against catastrophic losses. And government insurers, public auto insurance in some provinces, but not in Ontario. If you remember nothing else from this video, remember this. Exam questions in this area almost always test who owns the company and where the profit goes. If you can answer those two questions for stock versus mutual, you'll get these questions right every time. That's it for types of insurers. If this helped, drop a like and subscribe if you're following along with the full RIBO Level 1 series. Next up, we're covering policy structure, declarations, insuring agreements, conditions, and exclusions. See you in the next one.